What is up, everybody? Welcome back to Fed Watch on Bitcoin and markets. Brand new show, brand new template here for Fed Watch because Fed Watch is not going to be appearing on Bitcoin Magazine anymore, but I'm going to keep it rolling. As you saw in the intro graphic there, this is your alternative Bitcoin and macro analysis. A very good offshoot of Bitcoin and markets, but more central bank focused, more economic metrics focused, less focused on kind of maybe specifics about Bitcoin and hyper Bitcoinization and stuff like that. But Bitcoin is also a part of the central bank landscape and the monetary landscape out there in the world right now. So yeah, thank you guys for joining me. Happy Thursday. Hope you are all doing well. Up on the screen here, you see the homepage, bitcoinandmarkets.com. Go check that out. Let's see. What should we start with first? Let's talk about dollar wrecking ball. So this is a chart of the DXY, and I'm going to throw that over to Telegram since they can't see the live stream. Let me make sure all of my levels are correct and I'm going out everywhere. Yes, I am. Okay, so this is the DXY and the dollar wrecking ball for those people that have been asleep for the last few years. The dollar wrecking ball is because most of the debt in the world, or a large percentage of it, is dollar denominated debt. So other countries borrow in dollars, and the U.S. companies borrow in dollars, but companies and governments around the world borrow in dollars. Even some government bonds around the world are denominated in U.S. dollars, believe it or not. But if their currency goes down relative to the dollar, that makes debt repayment harder. It means they're having to pay back more. And so with the dollar wrecking ball, as the dollar gets stronger and stronger versus other currencies, it squeezes all other economies. I mean, it squeezes the U.S. economy too through domestic, debt repayment and stuff like that. But it's acutely felt all around the world, and especially in those bigger economies that have a lot of dollar denominated debt. So the dollar wrecking ball, as it goes up, it squeezes the global financial system, and people are really worried about that. This is the opposite of the inflationista narrative. So if the inflationistas think that the dollar is destined for zero, but as Brett Johnson of the dollar milkshake theory fame, he often says that the end of this is not inflation. The end of a giant debt bubble is deflation. Mises would agree. Rothbard would agree. Hayek would agree. But most of these inflationistas, they don't see it that way. They think that we can add debt to get out of a debt problem, and it just isn't going to work like that. So we should expect the dollar to continue to strengthen. One of the things I have been talking about for a while is going to a new higher plateau. So let me bring up some of these rectangles that I've drawn in the past and zoom out here. I'll go to the weekly so it's a little bit easier to see. And here we go. So this goes all the way back to the Great Financial Crisis, 2008, 2009. I'll put that here into Telegram. And these boxes are what I saw as a stair-step function. So the dollar strengthens relative to other currencies because the beginning of the end was the Great Financial Crisis. Okay, the beginning of the end of this debt-based era that we're in. And so the dollar strengthened, even though we did QE and we did all of this government spending, TARP and all of these extreme measures, the dollar continued higher. Okay. And you can see we went from a range that we held from about 2008 till about 2014. Then we jumped very rapidly into another range that we held about 90 to 100 or so. And we held that from 2015 through 2022, even through COVID. And you can see COVID is the COVID crash is this little blow off top that we had. It weakened slightly down to the bottom of that range, and then it exploded up. The dollar wrecking ball exploded up into a new higher range. And I kind of estimated that this box would be the new higher range that we enter for the next few years, the next 5 or so years, as other economies struggle with a higher dollar, stronger dollar. We're going to bounce around within a range, a new higher range. It didn't quite go that way. And I want to bring up some of these Fibonacci extensions and retracements, if this will come up. Okay, so what you're seeing here is back in the, and I'll share that with Telegram. I'm live streaming on YouTube, Twitter, Rumble, and Telegram. Telegram is where we hash it up all day long, going back and forth on Bitcoin and on macro and all sorts of stuff. You can check out t.me/Bitcoin and markets to get into the Telegram there. But okay, back to the dollar. You can see that I put this top of the fib 100% up here, back on this high in March of 2009. And then the low after that, I could have gone back here. And that might have matched the absolute high a little bit better. It doesn't really matter exactly where you put this bottom, whether you put it in the bottom of May 11th or the bottom back here in March of 08. But you can see we went to the 1618 extension. And I hope people can see that. I'm going to put an arrow right here. We hit the 1618 extension, and we went a little bit above it here to set this new range, but we stayed right in there for a very long time. Okay. Now, if we look at this next extension, Fibonacci retracement and extension, you can see that I measured it from this high that was in December of 2016 down to the next low, which was March of 2018, and then did an extension up to the 1618. And lo and behold, that's where we topped out. And back when the dollar was topping out, if you were watching my content back then, I was pointing this out. And I was saying, 112, 114 ish is going to be the target because of this 1618 extension on the Fibonacci's. So when the problem here, though, is this doesn't match my box. I should have drawn my box a little bit smaller. And let's see if I do that here. So the box probably should be about like this and maybe overlap a little bit here down into here. But that has matched with the general dollar behavior so far. And now we're breaking out higher again. Pretty interesting. But this is the type of analysis I've been doing for a long time. And people were talking about, the dollar is dying, back here after COVID in 2021, 2022. And then all of a sudden, boom, it ripping people's faces off, going all the way up to I think it got all the way to 114. So we could see that again, but I expect that the worst of the dollar wrecking ball is over for this cycle, actually, because if you go back here in time, back to 2015, most of those gains happened the second half of 14 and the first half of 15, and then it went sideways for like 6 or 7 years. So all of the gains might have happened already pretty much in the dollar, and we will bounce around in this range for the next 5 years or so. We'll see. But also what happened after the great financial crisis was the European debt crisis. And that's one reason why I said, okay, after this time, we're going to see something similar, the European debt crisis. Also, that China wasn't in a position to do what they did back in 08. So they were probably going to have problems too. So that's where my analysis started, down this road of bearish on China and Europe and relatively bullish on the United States. So we can also see some of this the same behavior here in the broad trade weighted dollar, because the DXY is only against the major currencies, mostly the euro. But here, let me go down to the daily here on the broad dollar, and it looks very, very similar. And bring up the 200-day. Even the 200-day on the broad dollar is very, very similar. And we are breaking out to new highs once again. And I'm going to share that with Telegram. The broad dollar there. And let's see. So let's look at some other currencies. Let's take a look at the CNY, because that is one of the big problems in the world. And I'm actually going to turn this upside down so it's a little bit more easy to understand, and take the EMA off. All right, so I should take all this stuff off too. Sorry, guys. Obviously, I was not prepared for this, but we're going with it. All right, I'll leave that up. So on this chart, as it's going down, that means the CNY is getting weaker. And remember, we were told for decades that China was the future, that this was the Chinese century, that the US and the dollar were dying. They, the end of the empire. And I stuck my neck out and said, no, that's not the way it's going to be. I was the only one in Bitcoin saying it for a very long period of time. Then a few other voices started listening, and the transitory nature of the CPI up and down over the last 18 months has started convincing more and more people. And we're hearing this more and more, as well as the problems in China and problems in the German economy specifically, but also in other European economies. People are starting to change their tune on this. But all right, so you see that the CNY actually went up relative to the US dollar on this reopening hope that it had end of last year into this year. It topped out and it started moving down. Then this red arrow down here is when they canned their existing PBOC head and replaced him with let's see if I can say this, Pan Zhongsheng. He is an FX expert. He ran their FX desk, or whatever they call it over there. I think it's called the SAFE program for the PBOC. And he was promoted to head of the PBOC. They had a little blip higher going into July, but it has turned back over and it's making new lows. They have seemingly given in to this. And the reason why I say that is I wanted to bring up a Jeff Schneider post here. You guys are probably all following Jeff Schneider, but if you aren't, I recommend doing that. And I'm going to copy this and put it into Telegram so you guys can follow. All right, so this is the way the FX program works over there in China is they have an official setting of the rate, kind of like how people talked about for years with gold. There was the gold desk, or what was it called? It was the London gold fixing price or something. And every morning they would fix the price of gold to where the market would open that day. And they said that there was a way that manipulated the price of gold. And it might have had a small effect, but over the long run, that's not going to have an effect. And we see they're trying to do the same thing here with the Chinese yuan. And the red line is the actual exchange rate. And the black is the official stance. And you can see that it started separating here back in the beginning of August. They didn't want to give in. They actually were raising it slightly as the CNY exchange rate was going down. And now they've given in. You can see at the very last little blip, they're setting it lower, and the CNY has just fallen off of a cliff. So I thought that was a very interesting chart with the price fixing that Jeff has on here. All right. What else do I want to hit on? Oil. Let's do oil. This is going to be a shorter Fed watch, guys, because I'm trying out some new things, as you can see on the channel here. And so it's the first time solo running Fed watch, and we're just going to go with it. But all right, let's go into oil. And I am very surprised by this recent move. This is WTI. U.S. oil is actually, it's a derivative. It's a futures product, I believe, but it tracks very, very closely with the actual WTI price. And so it got as high as 88 bucks, and now it's starting to come back down a little bit. This is a fishy move, in my opinion, because the global demand is not there. Okay, there is no, like the global economy is slowing. That means there's less demand for oil. A couple years back, I went through and looked at the global demand, which was, I believe, pre-COVID, it was about 101 million barrels per day. Then during COVID, it got down to like 94 or something, but it rebounded and it was starting to break 100 again. But I said that top might be in because of the rolling global financial crisis that we have is going to continue to lower and lower demand for oil. At the same time, we have the U.S. being the largest producer of natural gas, the largest exporter, pretty much energy independent. And let me bring up that, I'm going to bring that chart up. If I can remember the name, let's see if this will go to it. Bear with me, guys. Trying to find this here. The guys from my neighbor's lawn decided to come right now. So he's cutting outside my window. All right, here we go. Let's share this chart. So we hear a lot of talk about, the Strategic Petroleum Reserve, but very little talk about how much we're just producing in oil. I mean, let me blow up this section. We have really spiked here in the last few weeks. And actually, what I'm going to do is just take a screenshot of that and share that with Telegram. So we've gone all the way up to 12.8 million barrels per day. And the highest that we ever have produced is 13 million barrels. So we're really close. And that is even with all of the horrible policies from the Biden administration. So, if another president gets in there next year and they drill, baby, drill, the U.S. could be producing 14, 15 million barrels per day within a couple years. That's incredible. At the same time that we have global demand falling because China, their miracle's over. We have a demographic collapse in Japan and South Korea, in Europe. Germany is deindustrializing as we speak. The demand for oil is going down as the U.S. is becoming the greatest producer and really cranking it up. And now you can see that if I go back to the chart, and I did have on here a bunch of arrows and things. So let's see. So these are all the recent OPEC cuts to production. And they did just announce that they were going to continue the cut out until the end of the year. I think it was one of these cuts, whether it's the 2 million barrels per day or one of these cuts had a deadline of the end of this quarter. And they said they're going to extend it out further to the end of the year. So, that might have had something to do with it. But on this topic, I have another chart here from Jeff Schneider. Again, I recommend following him, Jeff Schneider _AIP on Twitter. But here he has the WTI futures price. It's going up, but the 10-year and 5-year break-evens, which are kind of a future growth and expectations measurement, they're going sideways or down. Okay. And he's pointing out that we saw the same thing kind of back in the middle of 2022. We had the initial spike from February 24th when Russia went into Ukraine. Then we had a little bit of the oil price accelerating in May and into June, even though the break-evens were signaling that, we're going into a slower economic period. And then finally, the oil price followed it. So Jeff Schneider is showing that this is very similar to right now. And I totally 100% agree with this analysis. I think there is a disconnect in the price of oil with the underlying economic activity out there in the world. There's another guy here on Twitter. Let me go back to the oil chart. There's another guy on Twitter. It's like Cowboy, but it's spelled Kao. I can't remember the entire handle, but he was saying that one of his thoughts is that MBS over there in Saudi Arabia was pumping the price of oil in order to sell in size, and capture the downward movement. So the ability to temporarily push the price higher, artificially manipulate the price higher with news and other things, and then sell and make everything go back to normal. So excuse me. So that's a possibility as well. There could be some funny business going on. But also, the higher oil goes, the worse it is for the global economy and people trying to make their dollar payments. So the higher oil goes, the more stress it puts on people paying off their dollar loans. Over and over, rinse and repeat. So the higher oil goes, the more economic damage it does, and the lower the future demand. At the same time, the U.S. is pumping ungodly amounts of oil and probably will increase that in the future. A lot of people think that the U.S. has maxed out their fracking, maxed out their production capability, but they haven't. I don't understand why people think that. There are 6 trillion barrels of economic shale in the United States. 6 trillion. It's like 80% of the global shale is in the United States. And now we can do horizontal drilling and we know how to get to it. The price of oil is going to fall over the next 5 to 10 years. I've done a lot of analysis on this on my Market Pro. This is the premium newsletter that I put out, showing different eras, like, from the 70s into the 80s. And then there was an oil glut that lasted for about 15 years, starting in the early 80s to around the year 2000. Then we had the price going up into the great financial crisis. So that's similar to the 70s. And then we have hit kind of an oil glut period here again. And this could last for, another 10 years. So anyway, that's my analysis on oil. Let's see what else we have here to talk about. What is this one? No, we don't need to talk about that. All right, let's talk about this one. So ISM numbers came out. ISM manufacturing in the United States was under 50, and 50 is the measure of flat. If you're above 50, you're expanding. If you're below 50, you are contracting. And so ISM manufacturing came out as 47, I believe. So that's contracting. But ISM services surprised to the upside. So the headline here from FX Empire is U.S. ISM services PMI climbs to 6-month high, dollar climbs. Services. The Institute for Supply Management, ISM, revealed that U.S. services sector activity jumped in August, hitting 54.5. So that's a big, big number if we're supposed to be in recession. Okay. Recording a 6-month pinnacle comfortably north of the median forecast of 52.5 and up from 52.7 in July. So they were expecting it to go down a little bit from 52.7 to 52.5. And actually, that's not going down. That is a slowing in the rate of increase. So anything over 50 is an increase. And if you go from 52.7 down to 52.5, that would be a slowing in the rate of increase. But it actually wowed them. It way overperformed at 54.5. This marks the 8th consecutive month in expansionary territory for the services PMI. Again, the US, I mean, if you look at these numbers for like Germany, say, they're all very negative. The US is still up here at 54, which is surprising to the upside, right? This fits into the overall idea that the US is going to be the cleanest dirty shirt, which is what I've been preaching. So Anthony Neves, chair of the Institute of Supply Management, commented, quote, "There has been an increase in the rate of growth for the services sector, reflected by increases in all 4 sub-indexes that directly factor into the composite PMI and faster supplier deliveries. Sentiment among business survey committee respondents varies by industry. However, the majority of panelists are positive about business and economic conditions." So very, very interesting here. Strong dollar, strong services sector, oil going up, all good things really for the US. All right, last thing I wanted to talk about was going back into Bitcoin. I mean, Bitcoin and US are tied at the hip right now. And even if people are, I don't know how you can be bullish on Bitcoin and not bullish on the United States when we have most of the big businesses, most of the big wallets, much of the mining in the world, the innovation in mining and electricity grids. All of that innovation is happening here, plus BlackRock and the ETF and on all this stuff. So I don't understand how you can be bullish on Bitcoin and not bullish on the US dollar. But anyway, here is from Bloomberg Tax, and this came out this morning. Long-awaited Bitcoin accounting rules to capture rises and dips. Bullet points are fair value accounting rules kick in starting 2025, so that's a ways away. Wrapped tokens excluded from final rules, all right? Crypto companies and other businesses with significant holdings of digital currency, they should say Bitcoin, will get long-awaited accounting rules to measure the value of the Bitcoin and some other crap coins. U.S. accounting standard setters unanimously voted Wednesday. Under new rules expected to be published by year end, companies that hold or invest in Bitcoin will be required to report their holdings at fair value, a measurement that aims to capture the most up-to-date value of an asset, including rebounds in value after price dips. While the new standard will inject volatility into the earnings of companies that are heavily invested in Bitcoin, the ability to record recoveries will be an improvement over the current practice. Companies and accountants have told the Financial Accounting Standards Board for months, quote, it's not very often that we can both take cost out of the system and improve the decision usefulness of information, and it makes it a really easy vote to do both of those, said Christine Bodison of the board, whatever this board is. What was this board called? Financial Accounting Standards Board. The rules will go into effect as soon as 2025, but companies will have the option to apply them early. Okay, great. Quote, it's a great step forward for the entire crypto market. I think it's a great step toward mainstream adoption, said Jeff Rundlet, head of accounting strategy at accounting software company Cryptopia or whatever that is. I can see finalizing this proposal to help large corporations that are maybe scared of holding Bitcoin on their balance sheet because they're scared of the technical complexities. All right, so long awaited. We've wanted this for a long time. I saw some positive reactions there on Bitcoin Twitter for this. I think it's normalizing Bitcoin. It's getting Bitcoin people more comfortable with the idea, applying standard practices and procedures to Bitcoin. I think this can only be helpful. So what else do we have? That's going to do it for today, guys. So new Fed Watch kind of format here on Bitcoin and markets. Hope you guys enjoyed it. My name is Ansel Lindner, and I'll see you on the next one. Bye.